Mr. Bikhchandani, how should an public market investor, I'm not talking about private market investor, a public market investor, largely our viewer, read into this very sharp reversal, which is a global phenomenon in some of the startup stroke new internet companies?
So I think most stocks have corrected, not just the startup stocks, but yes, the mid cap seems to have corrected more. The startup stocks seem to have corrected more. But I would look, for me to make sense of this, and I'm not making recommendations here, I'm not a market expert. I would say we have to wait for the dust to settle. Some of the underlying causes of this movement appears to be what the Fed has been saying and what the Fed has said they will do in terms of stopping the quantitative easing program, in terms of contracting the balance sheet, in terms of increasing interest rates. And all of this will have impact on markets around the world. In addition, there's geopolitics that is spooking the US market. In India, there's uncertainty around the budget. So I think in a week or so, things will be clearer. But yes, I mean, this is going to be choppy times. So let me explain to you. See, what happens when the Fed contracts its balance sheet? I think it's $9 trillion or $11 trillion or something. It is, with the Fed itself, I said, is much larger than it should be. Basically, liquidity contracts. When liquidity contracts, people go out of some of the investments. In addition, if interest rates are going up, then two things happen. One is the cost of leverage to invest goes up. The second is that, and therefore people leverage less. The second is that some investors will move from equity to debt because interest rates are higher. And the third is there are some investors, now this is important for the Indian private market, there are some investors who are late stage, pre-IPO, growth investors who are from overseas, and they have a mandate to invest both in private and in public markets. And should the equity prices in the US correct and they find they're getting good deals there in public markets, they will perhaps allocate some more funds there and perhaps fewer funds here. Having said that, there are other investors who have a mandate only to do private markets, and some of them have a mandate only to do India. They will stay. So we have to wait and watch a bit.
You touched upon Amazon, right? And spoke about even when the share price came down, the long-term investors ended up making money. But just taking forward that point of view, the investors in India are still not used to loss-making companies with maybe no road or a very long road towards profitability. They've been burning cash, they've been raising serious bucks and burning cash to either onboard consumers and give all kind of freebies. What are the lessons that we are now learning post this big sell-off, and lessons maybe that we didn't learn earlier from Wall Street?
As I always say, history keeps on repeating. Like the tech boom and bust, which happened in 2000, also happened in 1960. So people tend to forget. As I always say, that people's memory is very short. Basically, human brain is wired for the short term. But having said that, I think the key lesson out of this would be that focus on businesses that are likely to do well, and look at least some kind of profitability coming into the company within a shorter period of time. And for me, shorter period would be anywhere between 3 to 4 years. So an investor in these type of companies needs to be patient at least for 3-4 years to see to it that the company starts generating profits. And that is the reason why I always believe that these type of companies, one should invest slowly. And again, relative valuation is the biggest mistake which people do. Like there would be a company which has a similar business model in US, which is quoting say 65 times sales, while as in India it's quoting 20 times sales. And because of that, people invest in that the company is likely to do well over a longer period of time. I think that is not the right way to look at it. Ultimately, it's free cash flows. So free cash flows over a longer period of time or a good business model. Ultimately, I always lay stress on business model. So if the business model is good, it can generate free cash flow over a longer period of time, people should get into it. Shorter term investors, I think it's for them, it would be a lesson learned, and they would get out, but in all probability get out at the wrong. That's what I think.
what explains the excruciating tech sell-off? I mean, even globally, if you look at it, the Nasdaq, for instance, excluding yesterday's rebound, is down 12% on a year-to-date basis as well. I mean, even back home, be it Zomato, Paytm, Nykaa, all these stocks have hit fresh lows for themselves. Some of them, like a Paytm and trade are already quoting 50% below their issue price. What explains this synchronized tech sell-off that you're seeing across world markets? I mean, are they falling under their own weight, or is there some other reason behind this?
Synchronized is the word that you very rightly use. And I think this synchronized sell-off, in a sense, explains that the reason behind this sell-off is also possibly the same across different markets. Whenever we have the likelihood of interest rates rising and therefore the likelihood of cost of equity rising across all markets, the valuations, which are essentially the discounted present value of the cash flows that are going to accrue from these companies, these valuations tend to decline. Now, for the companies that we're discussing now, these tech companies, majority of their valuation actually is in the terminal value, because in the short term, they're not really likely to generate any kind of cash. These valuations, where a majority of the value is in the terminal value, they tend to suffer more when there's a risk of cost of equity increasing. And that's a universal truth. It's just a simple arithmetic that we have to live with. So it's no surprise that when there's a possibility, when there's an expectation of very sharp rise in cost of equity, it's these companies that don't have near-term valuation support, they tend to suffer more. And that's something that we are seeing across the world today.